This episode is brought to you by Accenture. When your advertising operations fall out of sync, everything else follows. Spotify and Accenture are working together to reinvent the rhythm of ad sales, using automation, analytics, and smarter workflows to simplify campaign delivery and access better data across the business. The result? Less time spent on operations, more time connecting brands with the moments and fandoms that matter most. Learn more at accenture.com/Spotify.
When you need to build up your team to handle the growing chaos at work, use Indeed Sponsored Jobs. It gives your job post the boost it needs to be seen and helps reach people with the right skills, certifications, and more. Spend less time searching and more time actually interviewing candidates who check all your boxes. Listeners of this show will get a $75 sponsored job credit at Indeed.com/podcast. That's Indeed.com/podcast. Terms and conditions apply. Need a hiring hero? This is a job for Indeed Sponsored Jobs.
Welcome to Learn Finance 101, where we break down the key historical events within finance and economics. In this episode, we shift our focus to a quieter but profoundly powerful force that has been reshaping global capital allocation for the past 2 decades: the rise of sovereign wealth funds. This is the story of how a handful of nation-states, primarily oil-rich Gulf countries and fast-growing Asian economies, have accumulated trillions of dollars in surplus wealth and transformed themselves from passive resource exporters into some of the most influential long-term investors on the planet. Sovereign wealth funds now manage more than $12 trillion in assets as of February 2026, a sum larger than the GDP of every country except the United States and China. They own significant stakes in the world's biggest companies, iconic landmarks, cutting-edge technology firms, sports franchises, infrastructure projects, and even farmland. Norway's government pension fund Global is the largest single owner of listed equities on Earth. Saudi Arabia's public investment fund has become one of the most aggressive and visible players in global markets, backing everything from Uber and Lucid Motors to Newcastle United Football Club and the LEV Golf Tour, Singapore's Temasek and GIC, Abu Dhabi's ADIA, Qatar's QIA, Kuwait's KIA, and China's CIC have quietly built portfolios that span every continent and asset class. These funds are not traditional investors. They are extensions of state power, long-term, patient, often geopolitically motivated, and largely insulated from short-term market pressures. Their rise reflects a historic shift in global capital. The center of gravity for long-term investment is moving away from Western pension funds, endowments, and private equity towards state-controlled entities in the Middle East and Asia. This episode will explore how sovereign wealth funds were born, how they grew into trillion-dollar behemoths, the strategies and controversies that define them, their role in reshaping industries and geopolitics, the risks they pose to markets and democracies, and what their continued expansion means for the future of global capital as we stand in February 2026. Let's begin by going back to the origins of sovereign wealth funds in the mid-20th century, when a few small nations first realized they could turn resource windfalls into enduring national wealth. The modern sovereign wealth fund concept emerged in the 1950s and 1960s, but its intellectual roots are older. Kuwait created the first formal SWF in 1953, the Kuwait Investment Board, later the Kuwait Investment Authority, to manage oil revenues after independence from Britain. The idea was simple. Rather than spend all oil income immediately, save and invest a portion for future generations when the oil runs out. Norway followed in 1990 with the Government Petroleum Fund, now the Government Pension Fund Global. channeling North Sea oil revenues into a diversified portfolio to avoid the resource curse, the economic distortion that often afflicts oil-rich nations, Dutch disease, corruption, boom-bust cycles. These early funds were conservative, heavy in fixed income, modest equity exposure, minimal private assets. They were designed to preserve wealth, not to take big risks. That began to change in the 2000s as oil prices soared. Brent crude rose from under $20 per barrel in 1999 to peaks above $140 in 2008. And Asian economies generated massive trade surpluses. The Gulf states, Saudi Arabia, UAE, especially Abu Dhabi, Qatar, Kuwait, saw their sovereign funds grow explosively. Abu Dhabi Investment Authority, ADIA, founded in 1976, became one of the largest with estimates of $1 trillion, plus by the mid-2000s. Qatar Investment Authority, QIA 2005, grew to approximately $500 billion, investing in London real estate, the Shard, Canary Wharf, Volkswagen, and luxury brands. Saudi Arabia's Public Investment Fund, PIF, originally a small domestic fund, was restructured in 2015 under Crown Prince Mohammed bin Salman's Vision 2030 plan to diversify away from oil. By 2026, PIF manages over $1 trillion and has become one of the most aggressive global investors. In Asia, Singapore led the way. Temasek Holdings, 1974, and GIC, 1981, were created to manage foreign reserves and government assets. Both adopted active, long-term strategies, investing in global equities, private equity, real estate, and infrastructure. By 2026, Temasek and GIC together manage over $1 trillion, with stakes in Alibaba, Tencent, ByteDance, and major US and European firms. China's China Investment Corporation, CIC 2007, was established to diversify its massive foreign exchange reserves. It now manages over $1.3 trillion, investing in Blackstone, Morgan Stanley, and global infrastructure. What makes these funds different from traditional investors? They have extremely long time horizons, often intergenerational. They face no quarterly earnings pressure or redemptions. They can invest in illiquid assets, private equity, infrastructure, venture capital that require patience. They often pursue strategic goals: technology transfer, geopolitical influence, economic diversification, or soft power. Many are state-owned or state-directed, raising questions about transparency, governance, and potential political interference. By February 2026, sovereign wealth funds collectively manage more than $12 trillion, larger than the GDP of every country except the US and China. They are among the largest owners of listed equities globally. Norway alone owns approximately 1.5% of every public company on major exchanges. They have become critical sources of patient capital in private markets, funding AI startups, renewable energy projects, data centers, and infrastructure in both developed and emerging economies. Their influence is visible everywhere. Saudi PIF owns stakes in Uber, Lucid Motors, and Newcastle United. Qatar owns chunks of Volkswagen, Barclays, and Canary Wharf. Abu Dhabi's Mubadala and ADIA back SpaceX, ByteDance, and global ports. Singapore's Temasek owns significant portions of Tencent and Alibaba. These investments are not passive. Many funds take board seats, push for strategic alignment, or use capital to gain technology or market access. But the rise of sovereign wealth funds has not been without controversy. Critics raise concerns about lack of transparency. Some funds, for example, ADIA, QIA, publish limited public information. Governance varies widely. Norway's fund is highly transparent with strict ethical guidelines, divests from tobacco, weapons, coal. Others are opaque. There are fears of geopolitical leverage. Saudi Arabia's PIF, fund in Leaf Golf, was seen by some as sports washing. China's CIC investments have raised national security reviews in the US and Europe. In Western democracies, the idea of foreign states owning large stakes in strategic companies, tech, energy, infrastructure, sparks unease. Despite these concerns, sovereign wealth funds have become indispensable. They provide long-term capital when pension funds and retail investors focus on short-term returns. They stabilize markets during volatility, for example, buying during 2020 COVID crash. They fund transitions, green energy, AI infrastructure, emerging market growth that private markets alone might underinvest in. In 2026, the sovereign wealth fund era is accelerating. Oil states diversify faster amid energy transition. Asian funds grow with trade surpluses. PIF targets $2 trillion by 2030. Norway continues ethical investing. Singapore and China expand globally. The center of gravity for patient strategic capital is shifting from west to east and south. The sovereign wealth fund era is not just a financial story, it is a geopolitical and economic realignment. Nation-states using capital as a tool of power, influence, and survival in a multipolar world. They remind us that finance is never neutral. It is shaped by those who control the surpluses. Thank you for listening to this episode.
This episode is brought to you by Accenture. When your advertising operations fall out of sync, everything else follows. Spotify and Accenture are working together to reinvent the rhythm of ad sales, using automation, analytics, and smarter workflows to simplify campaign delivery and access better data across the business. The result? Less time spent on operations, more time connecting brands with the moments and fandoms that matter most. Learn more at accenture.com/Spotify.
When you need to build up your team to handle the growing chaos at work, use Indeed Sponsored Jobs. It gives your job post the boost it needs to be seen and helps reach people with the right skills, certifications, and more. Spend less time searching and more time actually interviewing candidates who check all your boxes. Listeners of this show will get a $75 sponsored job credit at Indeed.com/podcast. That's Indeed.com/podcast. Terms and conditions apply. Need a hiring hero? This is a job for Indeed Sponsored Jobs.